In this video, we are going to look at why candlesticks are useful to retail traders. This is one of two videos in this course produced on PowerPoint. Although they don't look as good, it is the best way to convey this information. You now understand what information a candlestick can show us. But why is this useful? As retail traders, we are at a disadvantage from big money like banks and hedge funds. They have access to a lot more economic information than we do, and they also get the information we get a lot earlier than we do. Big money also have enormous budgets, in the hundreds of millions and billions. We as retail traders simply cannot compete with that. Candlesticks give us the ability to see what is going on in markets where it can't be hidden from us, in price. They offer us a roadmap and clues. We can then use what we are seeing in the price movements to try and trade alongside the predominant market forces. We essentially look to ride their coattails. Support and resistance is one thing we can see with candlesticks. It gives us clues as to where reactions will occur in the future. See the support and resistance lecture. However, the candles themselves can also give us clues. Let's look at two common and popular candles price action traders look for and go over what they suggest. We will start with perhaps the best known candlestick, the pin bar. Here we see 4 pin bars. People use different criteria for identifying pin bars, but we will stick with fairly accepted parameters. These are bearish pin bars. These are bullish pin bars. In both cases, the things we look for are the same. 1. We have a relatively small candle body, open to close price. 2. The tail of the candle is at least 2 times the length of the candle body. All of these candles have small bodies. The tail of each is at least 2 times the length of the candle body. How do we know if the pin bar candle is bullish or bearish? The main way is by looking at the tail. If the 2 times length tail points down, it is bullish. If the 2 times length tail points up, it is bearish. Why is this the case? Well, that is where the candlestick and what it tells us starts to play a part. Think about what these candles are telling you has happened to price during their formation. As they were forming, at some point they looked something like this. On the left, both candles look very bullish or positive. There are a lot of buyers. On the right, both candles look very bearish or negative. There are a lot of sellers. However, by the time they close, they all look very different. On the left, the candles tell us the bulls tried to force the market higher, but the bears forced them back down in a strong way. This suggests that the bulls or buyers may no longer be the dominant force. On the right, the candles tell us the bears tried to force the market lower, but the bulls forced them back up in a strong way. This suggests that the bears or sellers may no longer be the dominant force. Now, if we start adding in other clues, for example, we watch for pin bars at support and resistance levels, areas where we know trends can change. We only look for bearish pin bars after a strong bullish move and bullish pin bars after a strong bearish move, with the idea being that the move is starting to run out of momentum. We are starting to think like traders. This is a chart of the FTSE 100 on the 5-minute time frame. It is how my chart was set up on this particular day. We have a strong bullish move with the buyers forcing the market higher into a resistance level. We then see a bearish pin bar, and afterward the market comes down. At the bottom of the move, at a level of support, we see another pin bar, this one bullish, and we get another small bounce. This is the DAX on the 1-hour time frame. A move down, a bullish pin bar before the move up. This is the DAX on the daily time frame. A move down, a bullish pin bar, and then a move up. So now you can start to see why candlesticks can be so useful. We are able to take meaning from certain price movements we see. We can use certain price movements and candlestick patterns as a part of our trading plan. Price patterns are our clues as to what the money flow in the market is doing. Now we will take a look at another candlestick pattern that is well known, the engulfing candle. People also use different criteria for the engulfing candle. For this one, we will stick to what I look for with this candle. The engulfing candle is dependent on the candles that came before it. For an engulfing candle to be valid, the body of the candle, open to close price, must be larger than each of the 5 previous candle bodies, open to close price. A bullish engulfing candle is always green, and a bearish engulfing candle is always red. A bullish engulfing candle would look something like this. Here, the final green candle has a body that is larger than the previous 5 candle bodies. It is a bullish engulfing candle. The open to close price movement is larger than any of the previous open to close price movements. A bearish engulfing candle would look something like this. Here, the final red candle has a body that is larger than the previous 5 candle bodies. It is a bearish engulfing candle. The open to close price movement is bigger than any of the 5 previous candle open to close movements. What are these candles telling us that is useful? Think about it purely in terms of price movements. We have 5 periods of price movements, say on the 1 hour time frame. The market pushes higher in this time. It comes to a level of potential resistance, and then we see a bearish engulfing candle. That one candle is putting in a stronger price movement than any of the previous 5 hourly candles. It means that in relation to the last 5 hours, a lot of sellers are stepping in at the resistance level. Is that a useful thing to know as a trader? Of course it is. And if on the daily time frame we have the market falling to a potential level of support and then we see a bullish engulfing candle, is it useful to know that such a large number of buyers are stepping into the market? This is gold on the 5-minute time frame. We have a strong move down. The market comes to a support level. We can see it previously holding as support and also being tested as resistance. We then get a bullish engulfing candle and the market subsequently rises. This is gold on the 1 hour time frame. Here we see the market making bullish runs into a resistance area. The market confirms resistance here. We see a bearish engulfing candle the next time the market tests at that level and the market subsequently falls. Hopefully, you can now see why we find candlestick charts so useful. As you learn to read candlesticks, you begin to develop an ability to lift the rug and look at what is happening with money flow. This helps you make informed trading decisions.